Wycote, Wycote Capital. He's the CEO of Wycote, and he's joining us today. Aashish, good afternoon. Thank you so much for your time. Aashish, I was reading in the Economic Times this morning that a bulk of FIF flows which have come into India, large part of that actually are from sovereign wealth funds. In fact, sovereign wealth funds holding of Indian assets have hit a fresh record high. Now, I understand that Wycote also, has an business association with overseas investors in the advisory firm or some other separate fund firm. I'm not aware, but what exactly is so amazing about Indian market that sovereign wealth funds, which is much more long-term oriented, sticky money, not hot money, is now positioning in Indian market like never before?
Yeah, Ajay. So, very insightful question. Thanks for that. I think that, till very recently, there is also another piece of data which is very important. Like you said, the Economic Times report does mention that 14-15%, or maybe now it's gone up to 16%. 16% of all FPI money which comes into India, it quoted as saying that, it was related to sovereigns, either institutions which are more than 75% owned by some foreign government or a central bank of a foreign government or a sovereign wealth fund itself. It said that number has gone up all the way to 16%. But that is 16%. But what is the other part? Where is the other 84%? So that's where the insight lies. That bulk of the money which was coming into India till recently was, coming through a block, like a basket, like, global emerging markets funds or some BRICS fund or some Asian equity fund, etc. And it's well known that global emerging markets was the biggest block. And within global emerging markets, more like a 2 trillion asset class, and India would have been, say, 15% allocation on an average or 18% on an average or some such number. Now, you clearly know that last 1 year, global emerging markets as a basket or as an asset class is kind of broken because within that, whether you take China, you take Taiwan as a result of Chinese aggression, or you take Russia, you take Turkey, you take Brazil, which has swung from far right to far left. Multiple things have happened whereby you can imagine that almost 40-45% of the allocation in a global emerging markets kind of basket has been under severe duress. Now, obviously within this, India has been an outperformer and has demonstrated significant potential, which I think is widely agreed upon now. But the point is that if you're invested in a global emerging markets basket, if 40% of that basket is in trouble, having 15, 18, 20% in India doesn't really help. Now, the question is that people need to be a bit more discerning. So I think the trend going forward, hopefully, should be that instead of putting money as a basket, you should be willing to put more money into India directly as a single country. So to contextualize what the article says, obviously sovereign wealth funds or large institutions, they will be a bit more nimble-footed, they will be a bit more agile, and they are more likely to be directly registered in India as a FPI on their own, right? So they can very quickly increase allocation to India as a single country. But high net worth investors, retail investors, family offices, private bankers, wealth managers from all over the world who have been investing through global emerging markets, for them to change allocations, to identify India as a single country, identify the right manager or the right way to participate, maybe it takes a little bit longer. So single country managers like us, while in a year like 2022 also our net flows are positive, the point is that one would expect that institutions can be a bit more quicker in changing how they allocate versus people who invest through these retailish funds, they would find it that much more difficult to recalibrate. So I think that is what might help to contextualize this whole thing.
Right. Aashish, lately we've also seen that though we held on versus when the world was melting, especially two very large regions, US, almost 30% down from top, and even more China or Chinese stocks, I would say, be it within China or Hong Kong. But these have also come back in a nice manner. Do you think in the medium term, this could pose competition for markets like India in terms of foreign flows, or global capital may find these two areas much more attractive on valuations? versus us?
In my, yeah, so I think, always difficult to, take a macro or a top-down call, but, in my humble opinion, and I think I distinctly remember last we spoke was somewhere in the end of September 2022. I distinctly remember speaking to you at that time. My humble opinion is that, if there is a kind of relief rally in China, for instance, there was some expectation that they would withdraw their COVID protocols, or if there is a bounce in US from the bottoms, where people think that at some point in time Fed will pivot. I think I personally I wouldn't lend much credence to any of this bottom fishing or a temporary bounce back or a relief rally out there. And personally speaking, I wouldn't, nor would I even extrapolate our outperformance really. I think there are a lot of moving parts right now. Large parts of the globe are in some or the other kind of economic or geopolitical or kind of interrelated situations. India, again, if you see, while our economic performance and our corporate performance, one can mathematically argue and draw out various correlations or levels of isolation from the Western world. But I don't think that stock markets can be fully isolated. So maybe we can fall less for some time, maybe we can outperform for some time. But if some risk were to precipitate in any of the external markets, I would find it difficult to make a case that we will just come out scratch free. So I think right now there are many things which are not in the right shape if you see the external environment. So I would be hesitant to lend any credence to a relief rally in other parts of the world, and I would also be equally hesitant to just keep extrapolating
Right.
our outperformance in future.
Okay. Ashish, your fund is growing well, and good news on that front. Uh, and when you're talking to investors, distributors, and across the country, now achieving a very reasonable size in the industry last couple of years, talk to us. What do you get a sense on the strength of domestic flows, which is at a record high? The SIP flow at 13,000 crore. If we, for a moment, don't look at the lump sums, because one part of the investors try to time the market and they time the entry exit, but only look at the SIP, the stickiness of it. What is the sense you are getting across the country from all investor kinds? The mid-income, lower income, HNI, all kinds, because all of them now like MFs as a product. What's the feedback on ground?
So see, I think that people's willingness to stick to systematic investing is clearly there. I mean, there is resilience there, and there is sustainability out there. I have no reason to believe, as of yet, in any data or any of my interactions, I have no reason to believe that there is going to be a let up or that there is any disillusionment or there is any tentativeness as regards registering new SIPs or as regards continuing the whole SIP, way of investing is concerned. Because of two things. One is clearly, if you see, it's a great way to accumulate savings every month. Second is any which way, if you see stock market, it takes very, very long in an investing journey. If you see arithmetically, reaching that level of indifference or reaching that level of equivalence between lump sum and SIP sometimes takes 5 years, 7 years. For example, if you invested lump sum in October 2021, now from that level, for somebody 1 year has gone, they made no money. But if somebody has been persisting with an SIP, chances are that by the time the market makes the new high, their SIP has kind of started to turn positive. So multiple reasons why we always tell people that, SIP is the way to go. And I don't see any let up in that adaptation. But frankly, the bigger thing which I would read into right now is the salience of the lump sum flows, the other part which you mentioned. And just to give you a sense of numbers, let's say October 2021, September 2021, or any part, end of 2021, when things were really looking great in terms of historic returns, we were seeing, in certain good months, we saw 60-70,000 crore of gross inflow. And out of that, if you remove, say, that time SIP was 12,000. So from 60-70,000 crore, if you remove 12,000, then the monthly, I would call it discretionary investment or lump sum investment, was north of 50-55,000 crores. At least well over 50,000 crores was the discretionary investment happening in that given month. Today, I would say that number has dropped, that 65-70 has dropped to 30-35, and SIP number is more like 13,000. So what you will find is that the discretionary flow has gone down quite significantly in the last 1 year. I'm not counting, ETF has a lot of institutional flows, has a lot of, I mean, the retail participation is widening, but right now I'm taking more the active equity, hybrid funds, balanced funds, that segment. And I can see clearly that the flow has declined in the last 1 year. Maybe some way it is compensated because we are seeing institutional flows in ETFs or some retail flows, etc. But whichever way you cut the cake, the point is that the discretionary flows have slowed down quite significantly. This is evident in mutual funds, evident in AIFs, evident in equity PMS, etc. also. So my sense is that given that last 1 year return is practically zero or tending towards negative in some cases, I think that is why, and plus, heightened perception of risk, poor external environment, a lot of news flow in the markets. All of this put together, I think, has resulted in some slowdown or some tentativeness as far as making fresh investment is concerned. This will not get reflected in SIP because there the characteristic of investor or thought process is different. But the mood can be gauged from the discretionary investment, and I think that is where you are seeing a significant reduction.
Fair point. Fair point. Before I let you go, Aashish, one quick view on the valuations or the earnings trajectory. This quarter gone by was perhaps the worst quarter in terms of margin pressure in 10 years. And the sense is probably it will start mean reverting. But when you speak to your investment team and the people who work their numbers, what's the sense you're getting on the earnings growth trajectory? Does it look sustainable in next 3, 4 years, 5 years? Because returns will mirror earnings quality. And what range do you think is the reasonable range after stress testing the quality of earnings?
Yeah, see, I think that, clearly the aggregates don't seem to have a big let up. Like, recently I was reading some, street forecasts or estimates because obviously second quarter result season gone by. End of every quarter, people do release, upgrades, downgrades, fresh estimates and, how things are going. So if I were to look at 1 year forward, say FY 2024, there was a point in time people were thinking north of 1,000 for Nifty EPS. I think now I'm reading more anywhere between 950, 975, 980, those kind of numbers for 1 year forward Nifty EPS. So aggregates don't seem to have gone off much, say maybe 5% here and there. But I think the key point is that there is, like you said, margin pressure, and so that would result in sector rotation. Some sectors would relatively stand out and some would kind of come under pressure. So aggregates kind of sometimes don't give the clear picture. But net, if you really ask me, we have to be bottom up. We have to look for where the sector rotation or where the things are changing. But broadly, if you ask me, valuation is not the issue. I don't think, at least, we don't think that we are way too expensive or we are way too stretched. Barring few exceptions or, like you said, a quarter or two here and there. Other than that, from the last couple of years, on the upside, things have only surprised. Nobody was expecting that we would see this kind of buoyancy post-COVID. So net things have surprised on the positive. 1 or 2 quarters here or there, some sector rotation, that is part and parcel of the process. Net, I think that, one has to be constructive. It's not too, like I said, not so much to do with the valuation, but the external environment is what makes one cautious. Because even when things are attractive or even when things are fairly valued, temporarily they can get cheap also. Nothing stops that. So, I mean, rather than, it's our job to beat the benchmark by as high a margin as possible, as consistently as possible. But I think it's the absolute return which one needs to be wary about given the external environment.
Right. All right, Aashish, thanks very much for your time. Always glad our conversations